Good morning, everyone. My name is Lizette De Leon with the De Leon Group.
And my name is Ahmed Mohammed with America's Choice Home Loans.
And happy hump day. So today we want to talk about I've been getting approached about buying houses before the end of the year, and what are the not so. And Ahmed here, the best lender ever in Houston. He's gonna give us some tips on some myths that people don't realize, that they don't have to wait to purchase a house, and, things for you to consider.
Yeah, so one of the main things that you have to consider when you're buying a home, depending on the time of the year, is the taxes that you're going to get into. You have what's called the homestead exemption, which a lot of people are familiar with, and that's a special treatment you get on your primary residence that you own as compared to other properties that you may own for investment purposes. So that homestead exemption, it's only placed on a property on January 1st of any particular year, where you are allowed the ability to have a discount on most of your taxes, and it keeps the county from increasing your taxable market value by no more than 10% per year, which is a big advantage for most homeowners. So depending on what mortgage company you're working with and what part of town you're buying, it can make a big difference as to buying before maybe the tax bill being out and before January 1st of the next year, so that homestead exemption can be placed in your name. Because the way the rules are, for example, in Harris County, is that you own the home and you've actually have to have moved in. And one of the things that the county wants is also for you to have like moved your car registration or switched your driver's license address to the property to apply for the exemption in your name. And one thing that a lot of people don't know is some people don't, they will move in and they will forget to apply for their homestead exemption. And in Harris County, for example, you're allowed to go back and correct the most two previous years if you forget to do your homestead exemption. Because there's people out there that'll start noticing their mortgage, their mortgage payment going up if they have escrows. And when they really drill down into it, they see that their taxes are going up at a higher pace than they're supposed to. So that's a number one place. If you're getting a new mortgage payment and you're kind of confused about why it's going up so high, let's take a look at that mortgage, or let's take a look at your tax bill to see if that's the reason.
So, with that being said, if they go back 2 years because they forgot to do it for the new homeowners that, in Houston and the surrounding areas, do they get a credit from,
Yes.
for the past 2 years?
What they'll do is they'll go back and they'll take a look at what the market value was right when they got into the home. They will adjust it where they would only have done a 10% increase from year to year, and the difference that was paid is actually going to get cut back. In some cases, I've seen it cut back to the mortgage company, and if it's escrowed, and sometimes it's cut back to the consumer. So it just depends on how it's handled. I haven't seen enough people getting refunds to know if there's an exact rule that they follow. But it could be a couple $1,000s. I've had somebody that I met a while back that was complaining, and he was to the point where he was about to lose his home because the payment was just way outside his budget. And when we looked into it, that made the difference.
Well, and I've seen some mortgage companies like Wells Fargo. What they'll do is they'll send you a bank statement, and it'll say, do you want this applied to the principal? Do you want your payment to be lowered by this much? Or, so they give you choices, and when they don't hear from you, they just go ahead and apply it to the principal or cut you a check, depends on the mortgage company. So that is definitely something you want to look into.
Yeah.
Another thing that people think that it's better that the rates are gonna get lower after the year. The Feds dropped the rates about 3 weeks ago, so rates are the lowest they have been. What, 4 years
Yeah,
or
they've
so?
been fluctuating. But that's the big thing too. A lot of times, what dictates the interest rates in our market is the way the secondary market or the mortgage-backed securities market operates. So there's traders up top that are trading, mortgage-backed securities, which affects the price of interest that comes all the way down. So right now, I mean, I think it's a really good time to buy because we're not expecting any kind of major increases in rates. And over the past, I've been in the business for about 16 years now, and I have seen different markets with different rates. And We've had, like right now, in the general market, you should be able to buy a home with interest rates, in the high threes, low fours, or, with some lenders, are they're offering like 2.9.
Another thing is for people that closed last year. A lot of my people closed at 4.5%, 5.5%, and some even 6% with down payment assistance because, of course, rates were different in the past 2 years. So quite a few of my people had anywhere from 4% higher. What are the advantages of
Refinancing?
refinancing?
Okay. Yeah, it's
Not enough coffee.
that's cool. So refinancing, it's always a good thing if you could refinance your home loan and then reduce your payment or put yourself than you were before. And one of the things that you always have to compare is your current situation compared to where you can be with where the current market is. Now, the general rule of thumb is that you want to drop your interest rate by at least 2% to make it worth refinancing. So every underwriter and every bank today, when they refinance anybody, they want to make sure they have what's called the net tangible benefit. So they don't want you to refinance just to refinance or to refinance over saving $20 a month. There has to be a good
A
benefit.
significant.
Right.
So how much does 2%, just give us an idea. I know that of course, there's a lot of things that go into play and a lot of moving parts. But how much will 2% impact a monthly payment?
It could be anywhere between $50 to $150 a month, just in how much you're paying in principal and interest, depending on the loan amount. But the more that you owe, the more of a difference that you'll be affected by. Now, the other thing that people try to do is they try to remove mortgage insurance from the mortgage that they currently have by getting a new mortgage that doesn't have it. And the idea is, whenever you buy a home, if you're not making 20% down and doing a conventional program, you're going to have one form of mortgage insurance or another, depending on whether you're doing a government loan or even just a conventional. So the idea is you want to build up 20% in equity, so you don't have to have mortgage insurance at all. So depending on how fast the value of your home is growing year to year, and how much you're paying down, you could reach that between 3 and 5 years on average. And the idea when you refinance is to remove mortgage insurance altogether and get a better rate. Because of course now, when you're applying for a mortgage and you have 20% equity, it's more favorable to get you better rates than if you were to do a mortgage with maybe 5 or 10% down.
And what people need to also understand is when you refinance, you don't necessarily have to have any money. A lot of people are under the impression that they have to have the money to refinance, number one. So if you can answer that question. And number two, I know the process of refinancing a home, but can you explain the process? Because people are under the impression that the rules don't apply to them, as for the process, because it's the same as buying a new home.
It is similar to it. We still take a look at the value of the home, but there are some mortgages out there that you don't have to, we don't have to look at the value of the home again.
But you do have to have a job.
You do have to
You
be
do have to
working.
show
Right. You have to meet all the main credit
the
criteria.
criteria.
Your credit's got to be in a good position. You have to be making enough money to meet your liabilities and the payment as you had before. Uh, and what affects your situation is, let's say you don't want to pay any money to close. It's possible that you can include all your closing costs into your new mortgage, so long as there's room in your equity. So if you have paid down your equity and you're maybe at 15%, it may consume some of that equity to put back the closing fees into your new mortgage. Now, the other thing is, your old mortgage, if you had an escrow account, one of two things may happen. Either they give you a check back for how much money you've paid into your escrow up until the time that you refinance, or they will reduce it from their payoff, so you don't have to pay them off as much. So I've seen banks do it both ways.
Right. I lost my train of thought.
Yeah, so I mean, beyond refinancing, when you're purchasing a home this time of year, one of the things that people
No, it doesn't.
overlook is the tax credit that they get when they're buying a home. So whenever you're buying a home, depending on the time of the year that you buy it, the seller is going to end up giving you a financial credit for how much taxes that they were responsible for from January 1st of the year up until the time that you bought it. title companies will typically give you that credit on your closing disclosure, and it'll be calculated as taxes per day. So the idea is when you get that credit, it gets put into your new escrow account, and so at the end of the year, your bank can make the entire payment. So depending on the type of loan that you're doing, for example, if you're doing an FHA loan, we will, and let's say the seller is paying a lot of your closing costs. It's possible that part of that tax credit can be used. We'll consider like your down payment. So whenever the sellers are paying a lot, and we have situations where, Lizeth, you'll negotiate. She's a great negotiator, and she'll get a lot of concessions from the seller, and sometimes it's to a point where it starts creeping into their down payment. So if you're working with the right lender, we could use some of that money to go towards your down payment instead of having you to actually pay it out of pocket. Now you do have to have a matching amount in the bank, but the more that credit is, the easier it is for you to be able to buy the home. So that's always a big advantage, and a lot of people don't. Implement it. Yeah, the main mortgage program that you could do that with is FHA, because FHA is the one that allows that credit to be considered towards your down payment or to meet your minimum down payment requirement if, in a situation where the seller is giving a lot of concessions. So, some banks are real conservative with the way they do taxes because they just want to be in the safest position possible. So they won't allow you to do that. They'll want to over collect in taxes just so they'll be on the safe side, which puts you in a tough position. So, it depends. If you have a lot of money laying around and you don't mind spending it, of course, it's going to be on the safe side. You pay into your new escrow as much as possible. That way, you're guaranteed not to ever be short. But if your taxes are calculated specifically as to how much credit you're going to be getting and specifically as to what your liability is going to be into the next year, there's no reason to overspend, especially with the holidays around the corner.
One of the things that I think people are probably, the people that have the MCC program, the mortgage credit, when they refinance, they don't no longer qualify for that mortgage credit, do they?
When you refinance with MCC, you can have it I don't forget what the term is, like not reassigned but reinstated or something like that.
Because it's still you, just refinancing.
And some of the MCCs can actually be assigned to the new buyer if you sell the home. So there is a procedure for that.
Oh, that's
a
new one.
And so if you're selling a home and you've got the MCC credit from when you purchased it, you can actually reassign the MCC to the next borrower, and you could use that, because depending on the area, sometimes MCCs aren't offered everywhere for the same amount of money. So if, let's say, like right now at the end of this year, the way the state of Texas is operating, the only MCCs that are available give you 20 and 25% benefit. Earlier in the year, before they ran out of money, they were giving 40%. So if let's say you have a 40% MCC and you're selling your home, if you could use that to market your home and show the advantage to the next home buyer, what they would get, because that program may not be available anymore, but since you have it, you can assign it over.
Okay. Sorry, my chance. One of the things that I wanted to touch base on is those because it's been coming up a lot, and I guess because it's the end of the year and everybody's in a hurry to get, and how many deals we have on the table. I think one of the things that we need to talk about is flood insurance, and I think this guy here. So we have a deal right now that we're about to close.
Yeah.
God. But it was one of the toughest deals. So this girl has been trying to get finance for a home for a while. We did our due diligence and finally got them approved. So very last minute, it came up that they were on a flood zone because of remapping. But because of the way that Ahmed is able to do and his expertise, and one of the things that I love working with him is we were able to grandfather in the previous flood insurance for $350 a year. Otherwise, this deal would have been dead in the water because they would not have qualified. So I would love for you to talk a little bit about that, because a lot of people have lost a lot of deals on little things that happen like that, and somebody's been asked me about, and it just happens to be more often than
Flood is a a flood's an important thing. Of course, in Houston, we flood more often than we ever used to. And, we've had a couple of storms that have really, wreaked havoc on the entire city. And I think the flood maps have changed a few times over the years. And one of the things that you gotta realize is flood lines are not drawn with precision. They're drawn, with like an estimation. So the first time I experienced it, I had a lot of clients that I closed in the Sagemont, southeast Houston, and that area, part of that area was not in the flood zone, and then it was remapped into it, and then the mortgage companies that or the servicers that were covering my clients at the time, they just sent them out a letter that said, hey, now you have to start carrying flood insurance. And so they were like, "Man, we never expected this when we got into the home. What do we do? What do we not do?" So they had to go get flood insurance, and unfortunately, depending on where they were in the flood zone, it made a difference. How deep you're in, because the way the federal government works is they designate a certain depth over sea level that you're in a flood zone, and so the deeper you are, the higher your coverage is. So let's say you're and we'll talk about it from the perspective of someone selling a home and the perspective of someone buying a home. Let's say you're selling a home and you got put into this flood zone, or your flood insurance is super cheap. What typically that's an indicator is that you're barely into the flood zone per se, and that you aren't really supposed to be paying a whole lot, which is a good thing. And so in the situation of our client, the seller actually has had that policy for 10 years. And in order to get a new policy, we would have ended up spending over $2,000, or my new buyer would have ended up paying about $2,000 a year. So being able to get that,
Grandfathered in.
yeah, because it's not typical. It's not typical that you could pull the old policy into with the new buyer. It's like pulling teeth, and then some places don't want to do it. People don't want to cooperate. But one of the things that people, this is a good topic. If you are, let's say, selling your home and you're on the edge of a flood zone, there's something you can get a service you can get from a surveyor called an elevation certificate. So a surveyor goes out, looks at the property, and determines how high it is above sea level. But here is where it becomes important. Let's say your actual elevation is above the floodplain. So let's say the floodplain, is, I don't know, let's say in an area it's 40 feet and you're at 45, and 45 from the lowest point of your foundation. Technically, you're not at the depth of the flood zone.
Right.
So there's something called an ELOMA. It's an application that you can send to the federal government through the surveyor and through the elevation cert that exempts you from the flood zone. So what they'll do is they'll come around your house and they'll just kind of draw a line, and you're not in the flood zone. So when you look at the flood map, you'll notice that there's a lot of of ELOMA filings in certain depths of certain areas. And what it is, it's an application that person has made to the federal government to say, hey, I'm above the elevation for this flood zone, so I'm excluded.
Okay.
What that does is it allows them to get cheaper insurance, and when they sell the house, they can actually offer to show that the house is outside the flood range and it's safer than what people may think, which could help them actually get more for the property than they would otherwise.
I think an important question, and I think Marcelo can help us with this question, if you can come in here. I know one of the things, and he's the insurance guru here, and I think an important. This is Marcelo Granillo, and if you want to introduce yourself.
Hey guys, my name is Marcelo. I specialize in home insurance and a bunch of other type of insurance. But today we'll talk about home insurance.
But anyway, one of the things that I think is really important is when, people are on a flood zone, like me in my previous house. I didn't know that it was revamped. So the flood map was revamped, and I didn't even know that I was in a new flood zone. So can you elaborate a little bit on that with the new revamping of flood?
First of all, everyone should have flood insurance because it's extremely affordable. On average, it's about $350 a year, and you want to be active and have it actively, because if you ever remap and you become that you're in a flood zone, they will not change your premiums simply because they remap everything. They'll increase the cost of the insurance slowly, but they cannot increase it over 10%.
Okay.
So that's the first thing. And then when you're shopping around for a home, one of the things that I always tell people is pay attention where you're buying, because you might end up paying more for flood insurance than actually for home insurance. So we seen in Houston certain areas that they end up paying $3,000 a year on flood insurance because these areas are new developments, but they made them in areas where they're on the floodplain, and people are loving it. You know, they're getting this beautiful house. They're paying $1,700-$1,800 a year for a beautiful home insurance and everything, but the flood insurance is $3,000.
And please explain to people the difference with buying flood even if you're not on a flood zone, the importance of buying a flood insurance the day that you close on your house or previous.
So if you come up to
Versus-
the office and you say, hey, I want to get flood insurance, you're more than welcome to get it today, but it won't be in effect till 30 days later. So that's to begin with. If you are buying a home and you're closing on it coming up soon, that's a perfect chance to get it because it will become effective the day of the closing.
Right.
Okay, so that's one of the biggest things that is an advantage when you're purchasing a home. Take a look at it. If you can't get it, then get it, and you'll become immediately active. One thing, guys, that most people don't know, and they come looking for insurance when there's a hurricane coming up, and they're like, "Hey, can I get home insurance or flood insurance?" Absolutely not. We're not even allowed to sell it. That also happens in car insurance for a lot of people who don't know that. So
you can't take your car
you can't
for a
take your car
swim.
for a swim, you know, and hopefully the insurance will pay for it. So yeah, home insurance is very important, guys. But more than anything, simply get it. I mean, you can get it for $50,000 on the dwelling, with maybe $25,000 of personal coverage of your belongings, and it might be $300. I mean, we spend $300 on just about anything. So
Well, $300, it comes out to about $33 a month for flood insurance. Now, if something happens to your house, it makes a huge difference.
it does, because a lot of people that got flooded, they get money from that to be able to rebuild their home. And if there were damages to the roof and stuff like that, they also
It's
get money
covered.
from the home insurance. So you want to have those two coverages, because a lot of people think the regular home insurance covers water damage. It doesn't. I always tell people, if it comes from the top down, that's your home insurance. If it comes from the bottom up or the outside in, definitely not covered by
So
your home
since you're
insurance.
already here, can you go ahead and also touch a little bit on wind and hail, because that's a lot of things that a lot of people are not even aware of that they need.
Well, in Texas, we have to understand the coverages first. So I tell people, don't just simply go shopping for home insurance. Actually understand what you're getting. Because, for instance, a roof in Texas, it might be for 30, 35 years. That's what their lifespan is. But in reality, it won't last more than 15, 18 years. So that's a big problem, because when you're shopping around for home insurance and you have wind damage or hail damage, you might not even be able to get the right coverage on your home on a home insurance, or if you do, they might require you to replace the roof. And you're talking about between $10,000 to $15,000 easy on replacing that roof. So you want to make sure that you understand your coverages. And the question I get all the time, why is it so expensive? Home insurance has been going up year by year. It goes up about 5 to 8 to 10% per year. There's some companies that have skyrocketed up to 20, 30%. So it's important to keep shopping around for it. We have about 18 different companies that we have, because we have to shop around for that. Some companies are not even writing home insurance in certain areas of Houston because of the ratio of the losses they have had in the last years. Because of the hurricanes or the floods and things of that nature, home insurance has gone up, and the average price right now is $1,400. That's like the low end. So people are coming and saying, hey, I'm paying $800 a year. Can I get something cheaper? I wish, because we'll be selling a lot of it. But honestly, if you're paying $1,200, $1,300, $1,400, $1,500 a year, that sounds about right.
That's only doable like on a brand new house, though, right?
Now, it's also credit driven. Certain companies are credit driven. So if you have good credit, I've seen it with people who have good credit, they pay $1,100. And if you have messed up credit, you end up paying $2,500. So it makes a difference shopping around.
Now, does it make a difference when a person has a house and they want to replace the roof prior to selling it? They replace the roof and there's already a claim on that address, and then somebody else comes in, buys the house. Is that going to affect the person because there was a claim previously on that?
Those type of things usually have to be disclosed. A lot of people don't disclose
Don't
them.
disclose them.
So the thing is, having a claim on your home insurance or any type of insurance does affect you. One thing I tell people all the time is, don't call and put a claim because you think you have a loss. Call us first. We'll tell you what's going on and maybe get a second opinion before you actually put a claim.
Because simply having a claim does make a difference.
Absolutely. Your insurance is going to go up next year just because you had that claim. Whether you got paid, didn't get paid, or you got $300, your premium will go up.
I think I've heard of even just making the phone call.
Not necessarily,
to
but
make the claim.
I mean that would be a horrible company, but it might. It might. So a lot of times what people do is they contact us and we help them through the process, and a lot of times they say, "Oh, our roof got damaged and the wind damage and stuff," and honestly, they might have not even been 40-mile winds. And that's not wind damage. So when you call and you put that claim because of wind damage, guess what happens? They're not gonna pay you because there was
And you go
not
up
enough
on
wind.
the roof and throw water through the shingles.
Right, so a lot of times people say, oh, it happened last week. When? Why do you need to know? It just happened last week. I said, okay, if you want me to help you with the claim and so you can have a good claim place in there, I need to know when it happened, just about the time it happened, because if not, chances are you're not going to get paid.
Right.
So it's not just making a phone call, because every single decision you make regarding insurance does impact the next year. So when you have a claim on a house and you're buying a house and they don't disclose it, when you get the policy with us or with anybody, we can't figure out if
And why is that important? That's important because when we're doing a house and Ahmed's trying to figure out the numbers, Ahmed shops around for it. He doesn't shop around, but he says, go get 3 quotes. And he tries to go for the cheapest insurance, but just, what works. Because remember, that premium is going to make a difference in your monthly payment.
Right. And a lot of times what we do is, in our office, we try to help people out with the number. So I often ask them, so what's the number that you need to be in? Because I know what's going to work for them. So a lot of times you might want to have equipment breakdown. So if your air conditioner unit goes out, the insurance might be able to just pay for it, replace it or whatever. But if you can afford it right now, I'd love to give you the Cadillac. But if you can only afford, a Ford Focus, then that's what we'll give you right now. Next year, once you already have it.
Ford Focuses.
Well, no
Except
offense,
just go into
but
the Corolla or the Camry.
right, But the point is, even though you want it, the numbers might not work for your closing.
Right.
And that's what you got to focus on.
And that's where it's important to actually have, Ahmed and the insurance person involved, because you have to know what's.
Right.
Because certain loan types have to have certain coverages, right?
Yeah, we're looking for coverage for at least to cover the loan amount, and then the deductibles no more than 2%. So within those realms, you have a lot of options, but it all depends. Insurance is not. We actually, whenever we pre-approve a client, we have to estimate what we think insurance is going to run.
Love the mic, Ahmed.
Love the mic, remember.
Okay, so yeah, we have to estimate what it is, and so what I typically do is
we can share the mic. How about
yeah,
that?
there we go. This one or this one. So yeah, we typically have to estimate what we think the insurance is going to be, and one of the things that can spook people is if we are too conservative with the amount of insurance that we're going to have. Sometimes it scares the borrower because we're collecting at closing for 1 year's worth of insurance, and then if you have escrow, another 3 months or so into escrow. So any incremental dollar affects your overall picture together. It may affect the total amount of money you have to close, plus how much of a debt payment you're allowed to have in total.
Do you remember that deal that it was like $1 something over, and we had to tweak the insurance?
I think $1.33 and change.
And that was gonna kill the deal. So
Yeah.
he had to tweak the insurance.
We have done it before too, because they're like, dude, can you do something about it? We're like,
It really
oh God.
does
I said,
make
okay.
a difference.
Yeah.
It does. Every dollar counts, and so.
So everybody that thinks we're overpaid, that's a myth.
Now the last thing I say, guys, is do try to get with your agent and understand what coverages you got, because biggest problem is a lot of times you don't even understand what type of coverage you got. And when something happens, we simply come up and blame somebody. But there's 2 things you got to understand. There's replacement costs and actual cash value. Because most policies who are very, very affordable per se, because there's no cheap policies, are actual cash value. So they will take and say, well, this item that got stolen was 5 years old and it costed $1,000. So now we're going to depreciate it.
Okay.
So this thing was only worth $300 now. So here's $300. So the other type of policy, which is replacement cost, it would actually get you the same item, brand new, at whatever it costs today. Even though it was 5, 6 years old, as long as you can prove you had it and you had the model number and stuff, they'll replace it. And I've seen it happen. So those are the main things. Try to have the right coverage for you, or at least understand what you got.
So, I've heard of, I got a recommendation a long time ago that, and I've done this, I evacuate when we get storms, and so the last thing I'll do is I'm closing up the door. I'll go through the house and take pictures of everything.
I always advise have, whenever you get new electronics and stuff, take pictures of it, of the serial number, model numbers, save it somewhere in the cloud, because if something ever does happen, it happened to me. We got broken into a while back. And when we had to put the claim, it was interesting, all the things they ask you for. They just want to make sure you had it. That's it. They're not asking you necessarily for the receipt. If you have it, you bet you got it.
They're just gonna ask you an estimate of the cost.
Exactly. And if you prove that you had the picture with the TV that was 80-inch TV, that it was a Samsung, and this was the model and everything, that's all you need. It was 80. Well, it was 80. So those are the things that they're looking for, and you'll get it replaced. I got my laptops, my TV, everything replaced, and it was just fine. Yeah. So before you leave to a trip or a hurricane's coming or whatever, take a good picture of everything. Flip the TV, take a picture of the serial number and go with it, and pray nothing happens. Yeah. Well, I'm out, guys.
I think we're done for the day. Anything
Yeah.
you want to say to wrap up?
No, the only thing I just want to leave people with is to know that, any time of the year could be a good time to buy it. I would just recommend that if you're interested in buying a home and you're ready, to go ahead and do it before the end of the year. That way you could benefit as much as you can from any type of tax credits you're going to get from the seller that may help nudge you to be able to pay less to get into the home, and just to make sure you're there before January 1st so you can get your homestead exemption put in your name.
With that being said, is there such a thing as the MCC running out? Because
Yes.
Okay,
So-
someone told me that they couldn't qualify for MCC because they ran out of money. See, people, y'all need to hurry up.
Depends on the kind of MCC. There's multiple MCCs. So sometimes they'll run out of money, or what they'll do is when they're running out, they'll reduce the amount that they're giving so they can give it to more people. And so I'm signed up with at least 4 MCCs. So I've got, the best one I've got right now is TDHCA. But usually in January, February, they'll replenish the money. So you're still capable of getting one right now. You just have to get the right one. The mortgage credit certificate.
Got it. People don't understand those things.
Yeah, the acronyms and the jargon.
They hear me say it so much, they probably.
Okay.
MCC.
Anyway, thank you guys. We'll see you guys next week at 9:30. If you guys have any topics you guys want to talk about, let us know. If you need your house refinance, you can send me a direct message. Or if you're interested in buying a house, you want to sell it, buy it, whatever you need, let me know. My number is 281-205-3500. See you next week.